Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. To join me, go to my worstinvestmentever.com and sign up for our free weekly Become a Better Investor newsletter where I share how to reduce risk and create, grow, and protect your wealth. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guest Spencer Jakab. Spencer, are you ready to join the mission?
I'm ready.
Let me introduce you to the audience. Spencer is the global editor of the Wall Street Journal's financial and economic analysis column, Heard on the Street. Prior to becoming a financial journalist 20 years ago, he was a top-rated emerging market stock analyst. He's written 2 books, the most recent being The Revolution That Wasn't, about novice investors caught up in the GameStop mania. Spencer, take a minute and tell us about the unique value that you are bringing to this wonderful world.
Well, I used to work in a job like you. You were an emerging markets analyst, and analysts are supposed to talk to very sophisticated people and market to them all the time. And it's really sometimes, as you know, it's not about the quality of the ideas. It's about the quality of how you present the ideas, and you have to couch it in very complex terms. You can't couch it in simple terms because then what are you selling? What's the value that you're giving to people? And that's generally the case in finance too, right? People try to make things seem a lot of numbers and ratios and terminology and very complicated. But these days, last 20 years, I write for the general audience, and Heard on the Street is for a somewhat more sophisticated audience. But the whole point of my job is to take what's happening, explain it, bring a little bit of insight into it, but not to baffle people. And you need to explain things to people. You don't want people to be confused. And so that I feel is like sort of my superpower, if it will, is taking things that are a little complicated, have a lot of moving parts. Although finance is not rocket science, and it is rocket science. And when you get into some aspects of it, sort of derivatives and what have you, but and simplify it, because that is conducive to success in investing and in understanding the business world, is just breaking things down in the best way you can.
And maybe you could give us like a behind the scenes, like how you're sourcing the ideas, how you're then like, and what's your schedule like how often are you publishing, and how much lead time do you have? Are you, crunching to the last second? Or because I'm thinking about, I used as a head of research at Citibank, at CLSA here in Asia, I used to have my Friday, email I sent out, and yeah, it was a, I would say, stressful process, and just a process that required keeping on top of everything that was going on. I'm just curious, maybe you could just give us a little picture behind the scenes.
Yeah, journalism is all about deadlines, and I personally am not bothered by it. I would not function without deadlines.
Mm.
When I've written my books, I've set all sorts of artificial deadlines for myself, artificial word count targets and deadlines and what have you, and that's how I operate. And so there's a newspaper that's in print. There's newspapers still exist, and if you don't make the print deadline, then the stuff doesn't. You just have a big white space in the paper. So you don't want that. That's never happened. Um, I run a team. I still do write. I guess, the first editor of Heard on the Street who also writes for it regularly.
Mm.
But most of the time I edit. There are 13 of us around the globe, including some in Asia, in your region. And we operate around the globe we kind of, I have 2 people who work for me in the other 2 time zones. So one editing Europe and one editing Asia. And then I'm responsible for the bulk of the people in the US. And there has to be enough copy to fill a newspaper, and there has to be varied enough copy. And most of the ideas are self-generated. We generate them days in advance, and other things are generated by headlines. You had news. I don't know when exactly this will be running, but you had news this week about Binance being sued by the SEC, and then a day later, Coinbase being sued by the SEC. Well, obviously that was something that we had to comment on. Things happen, and you have to tear up whatever plans you had to write about something that was more thematic and jump on the news. And then you have earnings. A company's going to report earnings, or the Fed is going to meet, or that there's going to be a US CPI report, or jobs report that's pretty important for markets. So the schedule is either set for you, or ideally you can have a long lead time and just work on something really, really smart and insightful. But it's a mix.
And for the listeners out there, particularly for young people that are thinking about a career, in this type of career, there is a certain excitement about deadline, an intensity about deadline, that if that's something that doesn't kind of turn you on, it's probably not the best place to be. But I know I love the intensity, and that's what I enjoyed about writing. And so that's kind of interesting. And I can remember back in the old days when I was in the US and occasionally in Thailand, where I would receive the Wall Street Journal, which was like premium content in my perspective. And there's many people that have read the Wall Street Journal front to back their whole careers. And then, of course, it's not just in print anymore. It's all online and all that.
Right.
I'm just curious, from your for Heard on the Street, are you able to understand like which of the stories that you're doing is drawing more attention, and therefore maybe building on that story? Or how does it work as far as you getting more information of what your audience is appreciating?
Yeah, absolutely. It's very scientific now. There's more information than you can possibly cope with, really, in terms of the audience, because we have programs where I can see if someone clicked on it, when it's online, and most of the readership is online through the legacy website, through their iPhone, through their Android device. What site led them to it? Did they come to it organically through the app? Did they come to it linked through? And I wrote something last week about the recreational vehicle market. I wrote it, and so I looked at it, and it gives you a pie chart of where the readers came from. And one of the big sources of readers was an RV publication where they kind of, I don't know, and plagiarize it, but they basically copied half the article, and then at the bottom there's a link saying read the rest, and people luckily did click to read the rest, but they had about half of it there. So stuff like that. LinkedIn, Twitter, not that much through social media. A lot of it is really through people who come to the site, or through Google News or Google search, where they're searching for a topic, and then our article is one of the first ones to come up, and we know what time of day people watch it. We even, I don't really do it, but some people do A/B testing, where you have two different headlines, and the headline matters a lot. Sometimes it matters for search engine optimization, but it just what headline catches people's fancy. Sometimes you have ones that are oblique, that like an SEO professional will tell you, like, well, that's not really going to work, and it works like wildfire. I'll give you one example. My colleague wrote a piece at the beginning of this year, and then we turned it into a series that we all contributed to, called The Rich Session. He made up the term. He said, I want to write about the rich session, because we're not in a recession, but we're in a slowdown. And in this slowdown, the wealthier people, not that they're worse off, wealthier people are always better off, but typically the wealthier people kind of ride out an economic downturn, and poor people really take it on the chin. And now you have pretty full employment, lots of job openings, pretty good pool of savings, relatively speaking, for lower middle income people, and wealthier people. And you can see the layoffs in finance, and especially in tech. They're more anxious. And it was such a success. It had like 1 million page views, which is really a lot, even for the Wall Street Journal, for any individual article. And it, like, within 2 weeks, we were getting pitches from PR people about, hey, have you heard about the rich session? So that's when you've succeeded, when people are basically, we should have trademarked it. People are taking the thing that you've invented and sending it back to you. So that's the ideal. But we only hit a few home runs like that a year.
That's exciting. And if you think about my audience, who's, let's say, a broad-based audience, maybe 50% of my audience is in the US, 50% outside. Obviously, I have a lot of listeners in Thailand, where I am, and around Asia. Some people may not have a huge budget to get, and they may not be able to get the written format. What's the best way for them to subscribe and start receiving Heard on the Street, or just the journal in general? That's the kind of lowest cost way. Is it to go on the website? Is it to download the app? Or like, what would you recommend for people?
Well, they're always, if I compare us to our competitors, so there's like the Lex column at the Financial Times, which I used to write for
Mm,
uh, until 12 years ago when I came to the Journal. Um, there are a few other competitors like Bloomberg Opinion. Not only do I think we're the best, we happen to be the cheapest because you don't have to pay a premium subscription to get the Heard on the Street. It's just one of the other articles. It's a section, you can find it, and there are always deals for the Wall Street Journal. I mean, there are $4 a month,
mm,
or even cheaper than that. So it, it's not free. I mean, we have to feed our families, and so yeah, and subscription revenue is more than half of the revenue that the Wall Street Journal gets. And it used to be different. It used to be mostly advertising, but now advertising is because the print paper is not so dominant. We make probably, I think, 2/3 of our revenue through subscriptions, and so you can't sort of give everything away. But
mm.
it really is not that expensive. There are all kinds of student deals
Yep.
and whatever. So it's in terms of the content, you got to think about what a newspaper is. A newspaper is like the length of a book every day,
Oh God.
right? I mean, there's a lot of stuff in there. So I think it's good value for money if you're paying
Mm,
$4 a month for
yeah.
a book a day with lots of up-to-date information, and the book was written yesterday or written during the day. I mean, that's pretty good. Someone told me when I was in graduate school, and that's when I started reading the Journal. I used to read, I still do read other newspapers, but they told me that if you read the Wall Street Journal every day, it's like getting an MBA, which is not literally true, but I took it as a literally true. And I was not doing an MBA; I was doing a different kind of degree, but I was taking lots of classes at I was at Columbia University at the business school, um, and taking the MBA finance coursework, and yeah, I mean the paper. There was a lot more of the paper then. It was only in
Mm,
print. There was no internet in the beginning of the 1990s. But yeah, I would read as much of the paper as I could every day. I loved getting it. I mean, it was
yeah.
I went crazy for it.
Yeah. So I'm gonna put in some links. I'm gonna search around and go through some stuff to put in some links for everybody who's listening or viewing. If you're not subscribing, I mean, we have to face the fact that the competition in the media space is so tough that number one, maintaining a position like the Wall Street Journal is, impressive. And the second thing is that, we get the benefit of the competition because, as you say, the price is quite low. So I'm going to put that in so everybody can, check it out and follow what you're doing with Heard on the Street, as well as the overall everything that's in the journal. So now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it, and then tell us your story.
Okay, so um, I moved out to Eastern Europe. I was very excited about all the changes that were going on, the fall of the Berlin Wall and the opening up of the region. And I wanted to make money, but I also wanted to see history being made, kind of a twofer. And I moved out to Hungary because my mom and dad are from there, and I'm bilingual. And it was a good way, no, I wrote to all these investment banks and said, hey, I'm bilingual and whatever. I wrote to their offices in New York and other places, and a few wrote back, but they're like, no, I don't think so. But then, of course, everyone was really desperate for people who were bilingual and bicultural in the region. And so I, I basically did different internships when I was in graduate school just to get the addresses. There was no internet, like I said, in
Mm.
1991, 92, 93, as you recall, that did not exist. And so I got people's addresses, wrote them letters, called them on the phone when possible. It was an expensive long distance call, and said, hey, I'm going to be in Budapest on this week, and I got one of those courier flights. You remember those? Like, there were like these really cheap flights you could get before UPS and FedEx were so efficient, and you basically took someone's box abroad, and then you got like an almost a free flight. You couldn't take any a suitcase. So I wore my suit, took a box to Helsinki, knowing who knows what was in it, and then got a connecting flight to Budapest and had all these interviews with the local accountants and banks and stuff like that. And they all offered me jobs because they were like, that's great, and so I got my start. I was a country analyst in Hungary, and I had no idea what I was doing. I mean,
Mm.
I sat down
What
and
year
I
was
read
that?
a whole bunch of. So I did not know what I was doing. I had no idea. I mean, I was hired, and I gave a very convincing spiel but I didn't know what I was doing. And I was hugely, I had like a real kind of imposter um, complex. And, would meet these fund managers who were very wealthy, very nicely dressed, very suave, talking about all these things that they had done. Of course, they only talked about the good things they had done. And I just thought that they were so smart. And they would talk about how much money personally that they had made investing too.
Mm.
And the people at the investment bank as well, my boss included. He told me when he hired me that, like, oh yeah, last year was the first year that I made more in salary than I made investing in like a decade. And I was like, wow, how much do you make investing? Because his salary is really high. I mean, I just thought these guys, I thought like, if I follow their lead, I'm going to be really, really rich. And so I didn't have money at first. As a matter of fact, Andrew, my first investment when saved $5,000, I went home to go see my girlfriend, my mom, and whatever in the States. Went for a friend's wedding, and I wrote a check for $5,000 to Fidelity Investments, and I was so proud of having saved $5,000. And I made two investments. This was in 1994, beginning of 94, or end of 93. And one was a Southeast Asia fund, and you know all about this. Uh, Top of the market. Half of it went in there, and half of it went into a U.S. bond fund, which also was about to hit a bear market in 1994, as you recall. So that's not my worst investment, but that was pretty bad. That was like a wake up call. Kind of suddenly kind of dawned on me that it wasn't so simple to make money investing, but I was undeterred. And I would ask people, and some of the worst investments, really, if you think about it, are things that you don't do, right? So there was cell phones were taking off. I did not get a
Mm.
cell phone, I think, until 1996, but 1995, I asked the analyst who covered Nokia, um, this looks pretty good. I mean, what do you think? I mean, do you think that I should invest in it? And he gave me he really discouraged me. And I think he basically, like, he had just changed his call on it. It was a totally tactical call, but I mean, what I wanted was some investment to do really well. And you remember, like, every cell phone in the world was like a Nokia or an Ericsson 5 years
Totally.
later. Like, it would have been an amazing
I
investment.
know in
And
Bangkok,
he
it was
talked me
all
out of it.
Nokia.
Yeah, right. I mean, it was like Apple is today. And I was like, okay, well, he knows what he's talking about, and he did. But obviously, his long term vision was lacking, and I was looking for something to put money into and just not check it for 5 or 10 years. And then I met a fund manager who was very suave, very sophisticated, and he offered an investment to me. I mean, it wasn't his company, but he sort of, put his hand around my shoulder, said, "You should look at this company called YBM Magnex. It's really interesting, and they do this stuff. They make these permanent magnets, and it's really high tech. It's very cheap. Has a P ratio of, I think, it's like 8 or 9, which is very low. And I looked it up and read the annual report, and I still don't know what a permanent magnet is, but it sounded impressive and very high tech. And they had all these PhDs working for them. It was a Canadian company, and there are all kinds of red flags in hindsight, things that, like, as an analyst, you really should know, right? And not only did I invest in it, my first savings, kind of, besides that bad investment I made at Fidelity Investments, I, I bought the stock, and then I told my good friend, who's now one of my best friends, my colleague, uh, that this guy had told me about it, and he invested too. He invested the same amount of money that I had. It was actually, like, not a small amount of money, not at the time,
Mm.
for sure. And some time went by, and then I'm reading the newspaper, and I read that the FBI has raided the offices of this company, and that the whole thing is run by mobsters, and the thing was like just a front. It was the entire thing was a fraud, and it was run by this guy named Semyon Mogilevich, who was the godfather of the Russian mafia. And of course, it went 2-0, and there were years of, I just would read articles, and I felt so terrible. I felt much more terrible about having told my friend to
Mm.
invest in it than investing in it myself. But it was a total zero. And I mean, obviously there are other zeros in people's investing lives, but this is the worst kind of zero, because it didn't just go to zero because the company did poorly and I'd kind of taken a flyer. I just had no idea. I just went completely on this guy's word, who sort of disappeared. And actually, I looked him up right before the show. He's a professor somewhere teaching at a business school now. So I won't say his name or where it is, but I guess he thought it was good. He wasn't, like raising money for the company. My little bit of money did not make much of a difference, but that is, I was so embarrassed. And, for years, I'd articles, the prosecution and the liquidators, and I think 45 people were indicted, and the guy kind of escaped justice. And then later I'm not sure what happened to the guy. I think he's in Russia or Belarus somewhere, still free, but like all the sort of accomplices, and the whole thing was fake.
Mm. And how would you describe the lessons that you learned from that?
No one is going to tell you a great investment. No one, I mean, you should not, especially if you don't investigate it yourself. And in hindsight, I of all people, I mean, not that I was a very experienced analyst at the time, but I had the tools to investigate it, and there were all kinds of red flags. And in hindsight, first of all, it had gotten its start, and not to denigrate Canada, but Canada has much looser securities regulations than the United States does. It got its start on a junior exchange, which is filled with all kinds of flaky companies. Did a reverse merger, bought this company in the U.S. You know, I didn't know what a permanent magnet was. It had these activities, was suspiciously cheap. And I really couldn't explain to you what the company did. I mean, if you asked me, I'd say, oh yeah, they have this business making permanent magnets, whatever the hell that is. And the guy was just so suave and convincing. And I just wanted someone to you know, tip me onto the next big thing. And I
Mm.
have to say that, over the years, I mean, there have been cases when people have told me you should invest in this thing, and I was much more cynical. It was after that, of course, and and then I regretted not doing it. And there's one case that my sons bring up all the time to tease me, when someone asked me to invest in an airline. It wasn't even like didn't have an airplane yet. It was just a business plan. And by that time, I had been in the business a longer time. I think I was just about to become a financial journalist, but I had some savings, and I was like, "What, are you crazy?" Like, and I read to him some like quote that Warren Buffett had made about how airlines are terrible investments, and any right-thinking capitalist would have shot down Wilbur at Kitty Hawk if he had, and no way. And I would have made millions of dollars. It would have been, it has turned into a huge success. And I would have gotten in when it was at the stage of like a business plan on a napkin, basically. So, that those are the breaks. You have to miss out on those things sometimes. At the time, it seemed very risky, and much more risky than investing in a listed company that, had accounts and everything. So
Mm.
there you go. I mean, you need to do your own research. You need to be diversified. Certainly don't invest more than you can lose, which um, I was making good money, so I guess I could afford to lose it. And then I told my friend about it, and he invested it. I mean, I guess he's much less at fault because I told him to invest in
Yeah.
it, and he was also an analyst, but he also didn't really investigate it, and it just sort of, I was like really too embarrassed to say anything about it for years, and I wound up making pretty good money in the next several years. So it seemed, I won't say it's a rounding error, but it wasn't a devastating loss, but
Mm.
still, it was a very embarrassing loss, and a lesson to be learned. Just don't take investment tips. People, those who say don't know, and those who know don't say. That's generally the case.
Yeah. Interesting. Maybe I'll share a few things. The first one is do your research. And what I like to say is one rule is never buy a stock recommended by a person.
No.
And whether that's by phone call, by in person, and many people will respond to that by saying, but Andrew, how am I going to find a stock if I'm not getting a recommendation from someone? But everybody who's recommending something has their motivations behind it, which you don't know. And therefore, it's not to say that you wouldn't invest in that, but you need to do your research once
Hmm.
you do that. So that's the first thing. The second thing is, you reminded me of episode 62 with Jeremy Newsom a long time ago, where he basically invested some of his father's money in his first investment. It went really well. He went back to his father and he said, hey, let's do the next one. And his father gave him access to more money, and he proceeded to lose 100% of that money. And it turned out that was 100% of his father's retirement savings.
Oh, wow. Okay.
And so when you talk about the feeling of shame, of guilt, of, the way that you feel when you tell somebody something, I think it's a good lesson. And you've been real open about that feeling. It's a great lesson for the listeners and the viewers out there to make sure when you are into something that you're really excited about, calm yourself down when it comes to your friends and family, because if it goes wrong, you're going to feel awful. And so that's the second thing that's really critical is, focus on, taking care of yourself, but be very careful about starting to promote something to other people, because it can lead to some really painful, experience. Anything you would add to that?
Yeah, I mean, the only thing I would add to that is let's say that history had worked out differently, and that this guy had told me about some great investment that I had
Mm,
never heard of before. And I did the perfunctory research that I did, which really was perfunctory because I had no idea what I was looking at. And I'd made 10 times my money.
mm,
Um, and it had been a great investment. I would have thought that I was a genius, and success is the worst teacher. So I wrote this book about GameStop mania, and a lot of the people who participated in that, they opened their first brokerage accounts right around the time that the pandemic began. There were
mm,
about 10 million um, brokerage accounts opened by young people, Gen Z and millennials, right around that time because the stock market was a very exciting place. And you really could not go wrong. So in the
mm,
year from the pandemic bottom until a year later, 96% of American stocks went up. And the stupidest stuff went up the most. The things that were sort of the financial influencers on TikTok, the things that didn't have any profits, an index of profitless companies went up the most. So the sorts of things that other young people were egging you on to buy, whether through ulterior motives or just because it seemed cool, went up the most. And that turned out to be a horrible initiation into investing for that group of people because they thought that A, that it was easy, and B, that they had some knack for it
mm.
because they had picked so many winners. And they proceeded obviously to have a terrible time last year, and many people kind of threw in the towel. So yeah, so I guess I'm fortunate in a way to have started out with such a bad and embarrassing experience because it made me think very carefully. Probably made me too cynical in a way. I probably have missed out, like not just the airline, but other things that I could have invested in. And these days, because I'm a journalist, I don't invest in individual stocks. I invest in funds, which is
Mm.
not the road to overnight riches for sure, but is actually the soundest thing I think for most individual investors to do. Is as kind of plain vanilla and boring as that sounds, I think if you fancy yourself a stock picker and you want the intellectual exercise of investing, do it with a small amount of your money.
Yeah.
Don't do it with the bulk of your money. And because if you invest in diversified, low cost funds, buy and hold, keep things there, don't try to time the market, you'll do okay. You'll do better actually than 85% of fund managers over any 10-year period. So you'll actually be doing really well. Statistically, that's true. And then if you really want to sort of test your metal, and it might be luck anyway, but if you want to sort of play the game with a minority of your money and a portion that you can lose. I think
Mm.
that's a very important lesson.
Yeah, and that one of the things you just talked about is the idea of the index fund. The benefit of using some sort of fund or index fund is if you're in a position of privileged information about stocks, one of the steps that you want to take, at least I know in the CFA curriculum, is to avoid even the appearance
Right.
of, taking advantage of inside information or something. And so that's also a benefit of doing that for those people that are in that, situation. And also, I think that the other thing is what's kind of fun is when you look at people over time and how their perception of risk and of investing are shaped by these different, events that happen in their life. And one last thing is when you talked at the beginning about investing in the Southeast Asia Fund, which I believe was roughly around 1994, which was about the time that I started as an analyst here in Thailand. the stock market collapsed by about roughly 85%, and in US dollar terms, more like 90 to 95%. But the thing that I want to highlight is that the stock market in Thailand is still not back to the 1994 high.
Wow. Okay.
And that's same case after the US Great Depression, that it wasn't until World War II eventually got the US stock market out of it and through World War II. So 1935, let's say to 1955 or so. And then you have the Japanese economy, the Japanese stock market that still, it's taken 30 some years to get back just to where it was at its prior peak. And I've never done any research on it, but I've always had the opinion that the reason why, one of the main reasons why, is because there's a generation that gets wiped out. Mm-hmm. And then that generation, the risk and the pain that they suffered prevents them from participating in the market. And so there's nobody participating in the market until a whole new generation comes. And so I'm just thinking about the meme story and all the young people, because it's not just meme stocks, it's crypto that just wiped out so much money for young people, that it could be that we have now. America's a little different because you have international participation in the stock market. So even if a portion of the youth are not participating in the stock market for the next 20 or 30 years, it still could be that there was, foreign participation, but it's just a theory that there's a generational impact that doesn't change. People get their perception of the market from that first extremely painful event.
Yeah, you're absolutely right. I mean, it's so interesting, that generation in the late 1920s, that was really the first time that the broad American public invested in stocks. Before that, it was always seen as sort of a casino controlled by insiders. And, this is still before the SEC existed and all these protections, but it was seen as a kind of a legitimate, not a form of gambling. For the first time, it was seen as a legitimate thing. The first mutual funds really began to appear in the 1920s. They're called unit trusts, and they generally did not feel comfortable investing in stocks. So had you purchased stocks at the depths or near the depths in 1932, you would have done very well. I mean, I think the stock market had a P ratio of 5 or 6, had a dividend yield of 7 or 8%. I mean, it was, obviously, with the benefit of hindsight, a great time to jump in, even if you were a little bit early or a little bit late in terms of hitting the bottom. But it would be 25 years before the Dow Jones Industrial Average would get back to its previous level. And 25 years later, it wasn't the same people. The people who were 30 years old or 35 years old weren't, participating. 1954 was a great year for the stock market, by the way, the year that it finally went over the 1929 hump. It was a whole new generation that really wasn't scarred by that. This generation that got into the meme stocks, I see a different problem with them, because it wasn't such a jarring wipeout. They did not have a lot of money at stake. They had maybe their stimulus checks. They had small amounts of money. It was amounts of money that maybe they were embarrassed, and it's obviously painful to lose money. It's always more painful to lose money than it is pleasurable to make money. But I think the problem with this generation is that they have this notion of stocks or cryptocurrencies as being like a line that goes up. They don't know why it goes up. It's something that you need to get in early, and it's a whole sort of, it's a greater fool theory. They were buying, Hertz when it was bankrupt. They were buying all kinds of companies when they were known to be worthless, when people on television with no, dog in the fight were saying, don't buy the stock, it is worthless, it has gone bankrupt, you will lose all your money. And people were saying, what do you know? Or, it's going up and it doubled yesterday, and I'm going to try to get in on this train and then get out and find a greater fool. And that's very damaging, because that's not the basis of investment. The investment is literally something that, it's speculation rather than investing. And there is a difference between the two. Speculation is more of a gambling type of activity, and investing is something that you could put it in a drawer for 10 years and be pretty confident in it. And the other thing about investing is that the stock market exists in order to raise capital. If people generally come to think of the stock market as something that you just take a flyer, you get in, get out, and you got lucky, and you pick the right time, and somebody on Twitter was talking about the stock and it went up, and didn't I get lucky? That's messed up, because the stock market exists so the next Apple can be born, right? So I mean, obviously there are a lot of companies that want to be the next Apple that don't make it. The vast majority do not. But the next Apple is raising money today in the stock market, and in 20 or 30 years it'll be Apple, the way Apple is today. And if that company, and it might not be doing anything especially sort of shiny or interesting that kind of captures the public imagination, if it can't raise money, if basically people view the stock market as a sort of more like a gambling parlor, then that hurts the ability to form capital, and that's bad.
Mm. Yeah, I mean, that's markets need. I mean, all the markets around the world are trying so hard to have deep markets and good trading volume and all that. America's got all of that. So let's just hope that people can, maintain that. So let me ask you, based upon what you learned from this story and what you've continued to learn in your life, what would be one action that you'd recommend for our listeners to avoid suffering the same fate?
One action that I would recommend, and I think this is just the most common sense thing that I recommend to any neighbor, stranger, whatever, is that they should stop looking for the needle in the haystack. They is not a productive exercise. There's a very small chance, even if they have a friend or neighbor. As we talked about, my most embarrassing, worst investment, right? Very few people want to talk about that. And when you meet someone at a cocktail party, they do not talk about that. They talk about
Mm,
when they made a killing. People tend to play up the positive and downplay the negative. Don't fall for that. The vast majority of investors, I mean, the majority of stocks lose money relative to risk-free investments. That's a given of U.S. stocks, not to mention stocks in other countries where the markets aren't as well regulated, like Canada, where
mm,
IBM Magnets was. I mean, I don't know what the numbers are like there, but they probably are not any better, right? So you can, instead of looking for the needle in the haystack, buy the whole haystack. It's you're not going to get as rich because that needle is in there. It's going to go up, the Apples and Amazons and what have you, plus all the failures. But you're basically buying into a big diversified pool of investments that, unless the society collapses, unless had an index fund existed in Tsarist Russia in 1915, you'd have lost all your money in 1917 no matter what. Obviously, there's no getting around that. You had bigger problems. But assuming that American capitalism continues and that the economy doesn't fall off of a cliff permanently, we don't have a Japanese type scenario, and that even if we
mm,
do, because the Japanese stocks, it's like they went to zero, right?
mm.
They continue to pay dividends, and that it took a few decades, but they got
Yep.
back to where they were in 1990. You'll do okay. And even if there's inflation, by owning stocks mostly rather than fixed income instruments, you'll do okay because stocks are a natural inflation hedge. So
Mm,
obviously, don't bet it on a very risky index, but there are broad-based indexes with very low cost to invest. And this is something you could not have done decades ago,
mm,
by the way.
correct.
You hear all those stories like, if you had invested $1 in 1926, it would be worth, $121,000. Like, well, no, it wouldn't, because there's no S&P 500 index fund. You couldn't, even just investing in just a basket of stocks that represented the market, you would have been charged money to reinvest the dividends. So it used to be really expensive just to gain an entry ticket into the stock market. Today, it's very cheap. The
Mm,
costs are basically zero. It's a huge gift to you. You can reinvest your dividends for free. There are all these tax efficient vehicles. Just stick the bulk of your money in that. I know it's boring.
mm,
People don't want to hear it, and they kind of nod and say, "Yeah, you're right," and then they go out and buy something dumb anyway. And if I can convince 1% of the people listening to this who were thinking of buying some hot stock to do that, then that's 1%, more than we're doing it before. That is really the route to success. Be kind of cheap and lazy, buy a fund that you don't have to look at, and don't worry about it, and don't get spooked by headlines, especially. Just stay in there. As a matter of fact, when you blood is running in the streets, that's when you want to re-up your investments.
mm.
So that's my advice. It's a great resource. The investing world today is far more individual investor friendly than it ever has been.
And ladies and gentlemen, spoken by a man who wrote the book on GameStop mania. So is the index fund your recommended resource, or are there any other resources that you'd recommend?
I mean, I think that another resource that I would recommend, at least to those people in the United States and a few other markets, and people are listening to this in other countries, but I think this is spreading, are uh, robo advisors. Robo advisors are a very good resource. Robo advisors are basically, it's not a robot, it's an
Mm,
algorithm. So instead of sort of, I don't know, you might not know how much to put into an
mm,
index fund. When you get dividends, you might not know to reinvest them. Or let's say if this you put money into, 60% into stocks and 40% into bonds, and then you check it a decade later and then you're 90-10, right? Something not appropriate to your risk profile. The robo advisor is basically a very cheap mechanical advisor that's appropriate for most people who, especially who don't have a lot of money. An
mm,
actual advisor is even better, I think, as long as that person is a fiduciary. That's a legal definition. You should always ask your advisor
mm,
here in the United States if they are a fiduciary, and only invest with them. It's someone who has to be prudent about your investments, not someone who's just a salesperson selling you some overpriced annuity. Only invest with fiduciaries. But a robo advisor basically does it on autopilot and does it as cheaply as possible. They typically charge about a quarter of a percent of your assets a year or even less. And they will act in a very tax efficient way. So they'll sell your losers. They know what your tax bracket is. They will rebalance your portfolio on an automatic basis, which by the way is a way of being contrarian. If you
mm.
rebalance your portfolio according to some mechanical formula, the way a robo advisor does, well, you can do it yourself if
Mm,
you're sophisticated enough. That is a huge edge over the years, because basically you hear about people who kind of buy low and sell high. How do you do that? Well, let's say you have a portfolio of fairly risk-free investments and a portfolio of fairly risky investments like stocks, which, let's face it, are pretty risky in the short term. They're much more volatile. And the stock market has gone down a bunch and bonds have gone up a bit because there's a flight to safety. Well, all of a sudden, whatever percent you had in each, when the next anniversary of setting your investments has come around, you're way out of kilter. You have
mm,
less stocks than you allocated to, and you said my risk tolerance is that I will have this much in stocks. Well, you're going to be, in order just to get back into balance, you're going to be acting in a contrarian way. You're going to be moving, you're going to be zigging where everyone else is zagging, because they will be kind of running away from the stock market, and you'll be buying stocks, not
yeah.
necessarily at the bottom, because no one buys at the bottom except liars, but you'll be buying stocks once they've gone on sale, and you'll be selling some of your bonds once they've been bid up in a flight to safety. So by doing that on a regular basis, and vice versa, by the way,
Mm,
when stocks have been in an epic tear and they're a much bigger part of your portfolio than they really should be based on what you assessed as your risk tolerance, then the robo advisor, or if it's a target date fund, will do the same thing. Will, on a given date on the calendar, sell down those stocks and buy more bonds,
mm.
and kind of take some money off the table. So it's a really good strategy that in the long run adds to your performance. If you add a half a percentage point or a percentage point to your performance over decades of savings,
It's
you know,
huge.
get out Excel or a calculator and do the calculations and tell me what you see. It's a gigantic, it's a huge boon to your long run size of your nest egg. So
Yeah.
those are great resources. Again, I don't,
All
I should have like gotten a commission from some of these robo advisors. I can mention a few in the U.S., but you can
I'm
just
thinking
Google it
about
and
like,
find it.
well,
I think now Vanguard and Fidelity have their own.
yeah.
Schwab, I think, has its own, and then they're like Wealthfront is one of the ones here.
Is Betterment
Betterment, another
still?
one. They're a bunch, but one of the sort of better known, reputable robo advisors. They're all much of a muchness, and I do recommend them to people.
All right. Last question. What's your number one goal for the next 12 months?
My number one goal for the next 12 months is to make sense of this kooky economy. I mean, professionally, that is my goal. I think that this is a really, I mean, you could say that any time we're at a crossroads, this is a unique time. We're in a unique time. We have several indicators that are historically reliable that are telling us that the United States economy is going to go into a recession. We have, but when the U.S. catches a cold, or sneezes, the rest of the world catches a cold, right?
Yep.
So that's basically, we're talking about a global downturn in all likelihood. And then we have several indicators that are completely inconsistent, where there never has been a recession. So this is the most difficult economy to read. And so my goal professionally, and this of course cuts across all the things that we write about in the world, is to understand what's going on and be nuanced and don't get caught in a head fake.
Mhm.
When people say, when I'll go and speak to a group of individual investors or whatever, and they're like, you're telling us not to take advice from people. You're telling us to just invest in index funds and not to chase these individual stocks. You write about individual stocks in your column. You write about there might be a bull market, there might be a bear market. How do you reconcile that? I'm like, well, that's what people want. I mean, there's a huge audience of
Yeah.
I don't know what else to say. There's a huge audience of people who crave that. I try to obviously I have no agenda. I'm not,
Mm.
I can't even accept, bus fare from any outside organization. So, so that I'm not kind of corrupted, and so I'm calling it like I see it, but certainly not necessarily calling it consistently correctly. But I want to just intellectually and for the reader's interest to
Yeah.
sort of to get things right and to figure out what's going on. That's always what I'm trying to do, but especially now, it's just a total head scratcher. It's a really weird but interesting moment.
And here we are out in emerging markets where we're on the whipsaw impact of a US recession. If it happens, it can hit us particularly hard. So we're all interested in that. And I think that is a big challenge for all investors. So and you've got a good enough flow of information that you can judge that. I think when I look at it, it's a bit muddled. I have enough information to say I feel kind of negative, and these signals like the inverted yield curve and unemployment at an all-time low, knowing that that's kind of happens just before recession. But on the other hand, also you have an element that wasn't there when we started in the markets, and that is the Fed. You have this money
Mhm.
printing machine that can basically go in and pump up the stock market at any time. And the Fed has yet to go in and buy stocks. They came up with a scheme to buy bonds in the 2000, collapse,
Mhm.
which was an interesting method that they did to get around kind of their guidelines by having the Treasury set up a separate entity and then the Fed using that entity with BlackRock to signal that they're going to buy bonds. Really, it didn't take much money, just the indication that the Fed would do that. And so you've just got, all kinds of other factors. So it's a laudable challenge for the next 12 months.
Yeah, it is. Yes.
Well, listeners, there you have it. Another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. If you've not yet joined that mission, just go to myworstinvestmentever.com and join the free weekly Become a Better Investor newsletter to reduce risk in your life. As we conclude, Spencer, I want to thank you again for joining our mission. And on behalf of A Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
My motto is, and it's my motto outside investing too, is be cheap and lazy. Just that is the formula for success. Maybe not in outside of investing, but it is in investing.
Yeah.
Cheap and lazy.
Keep it simple. That's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, let's celebrate that today we added one more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.